Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Kaastrup Larsen.
Welcome back to this week's edition of the Systematic Investor Series with Andrew Beer and I, Niels Kaastrup Larsen, where each week we take the pulse of the global market through the lens of a rules-based investor. Andrew, great to have you on the podcast this week. How are you keeping, and where do we find you today?
Thank you. I'm at home. I moved to Connecticut in January, so I'm back where I spent a long time north of New York City. So I spend most of my time working here if I'm not traveling or in the city.
I hear you're going warm places next week.
Thank you. Look, thank you so much for having me back on. It's great to be here as always.
Of course, absolutely. I was just going to say that I just got back from Miami. I hear you're going to Miami. It's very nice and sunny down there at the moment. So I think it's
cold
time.
Actually. I was there for a grand total of about 36 hours this week, and then I go back for the ETF conference on. And it was really not terribly warm.
True.
Warmer than it was here, at least.
Yeah, exactly. Yeah, no, you're right. I mean, the Floridians, they complain about the temperature, but I thought it was really nice as a...
Well, and the hotel that we were staying at, in Celsius, couldn't have been much more than 18 degrees in the hotel lobby. I mean, you had people walking around with down coats. I mean, it was like they didn't dial back these industrial strength ACs when the temperature had dropped 20 degrees. Right. So
sounds like a Scandinavian summer to me, 15 to 18 degrees, but there we are. All right. We've got quite a varied list of topics lined up today, which I'll be excited to get into. Before we do that, I always ask you, just because I'm curious, and I'm sure our audience is curious as well, kind of what are the things that has come on your radar recently? What are the themes you're thinking about, which are not the things we're going to be talking about, but just generally speaking, what do you find interesting?
Well, I think one of the things I find interesting, I mean, to me, as somebody who's spent a lot of time studying history, it feels like a very dark time right now. The Middle East feels very dark. Eastern Europe feels very dark. The geopolitical situation seems very dark. The political situation in the U.S. seems comically dark in a lot of ways. And yet, so now I think when I talk to people, they think, Trump is favored to win the second term. And, which obviously strikes terror into the hearts of large segments of this country. But what I find interesting about on the business side is that is actually driving a fair amount of business optimism. That outside of the headlines and the acrimony and the anger and the sort of unpleasantness of it all, I think there is a view in the business community that we really got to clean up some of this, the extent to which the government is more and more involved in choking business activity in a way. So it's just a very strong phase, and I've just seen it in the past several months, where when it's become clear that Trump is really now favored to win, that coupled with optimism is fascinating to me. Yeah.
Someone reminded me on Twitter this week about my own 2024 outrageous prediction that neither Trump nor Biden will make it to the ballot in the end. And so we'll see. But I do share your points. And it is in some ways kind of interesting that we live in a world where we can certainly say that the uncertainty and the geopolitical risks are heightened to a level that we haven't seen for a long, long time. Yet a lot of the financial markets are doing really well. So there's a little bit of a kind of maybe a disconnect, because on one thing you could say, earnings looks great and et cetera, but there's just not being priced in, neither in credit spreads, et cetera. There's not being priced in that this could all go terribly wrong. So we'll see. All right, before we dive into the topics, let's do a quick review from a trend following point of view, and then I'll try and tie it in with your help to the replicator world, of course. And I mean, from my perspective, I would say the last week or so, there's a lot of trends that continue to play out in the trend following world. And I think a lot of trend followers are taking full advantage of what's happening at the moment after a somewhat more choppy year last year, the year of the whipsaw, as you coined it. And last week, I actually suspect that in a classical trend following portfolio, I think a lot of sectors have been participating in delivering the performance that we're seeing at the moment. Of course, with a few standout markets like cocoa, which hit all-time highs. And of course, I was a little bit curious because we've been talking about cocoa for a while now. And so I did look into it. And it turns out that some of the key countries in terms of supply, Ivory Coast and Ghana, they're seeing something like a 30 to 40% decline in supply due to some seasonalities and some winds and some dry weather from El Nino, I think was one of the causes as well that they were pointing towards. Anyways, kind of interesting at the moment. And of course, at some point, Andrew, this will feed into the price of chocolate. So we may not have to, we may not be able to afford our cocoa powder on our cappuccino next time I see you, but we'll see. Other than that, I think other sectors, metals, meat, for those who trade meats, energy, grain, maybe with the exception of something like soybean oil, also should have done pretty well. And actually also fixed income and equity positions. So incredibly broad-based, I would say, right now, with a few standout markets in trend following. We don't see that so often. And perhaps the only sector I can think of right now that may be struggling a bit is currencies. Not necessarily losing money, but just not making a lot from what's going on. And so I'm curious, when you hear these kind of drivers that I see, what do you see from a replicator point of view in terms of your own portfolio?
Yeah, so it's a good question. So we obviously we see a very simplified worldview compared to how you talk about it. And I think I think when Powell started talking November 1st, I was skeptical that this was the end, right? And obviously our portfolio and a lot of portfolios were very much betting on some continuation of higher rates. And even a month before that, people were talking about like, Powell doesn't have to raise rates again because the bond market, because yields have gone up. So when he pivoted and then he reinforced the pivot by basically saying, I was personally shocked by it, but that's not how we invest. We just try to figure out what you and other, not you, but smart guys are doing in the space who have the bigger, more diversified funds. But I've sort of come to the conclusion now that the hiking trade is over, right? You can bookend it. The big trade, getting it early, it being a really contrarian trade, and then by the end of last year, it was, if you were short term, you were already out of it and probably doing pretty well and protecting yourself. If you're longer term, it took a while to get out of it, but it's over, right? So we see sort of the action has gone in fixed income. We have like slight flattener trades out there. It's nothing terribly significant. But what I find really interesting is, I used to talk about the portfolio in 2022 as being in crash protection mode. There was a period of time where it was just bearish everything. And now we actually see it going risk on. So we've seen equity risk dial up. And I think the most interesting thing that we're seeing ties into some of the other stuff we'll talk about is with the US versus EM or international versus EM bias. And then also in the currency markets, our currency portfolios would be very simple, but it's also the decline of the yen. The yen is just incredible. And I think it's down 6% this year. And so if you're concentrated in that, it's been a big benefit. But I think the underlying theme in terms of what I talked about is there's underlying all this dark macro stuff. I think there is a different level of widespread optimism and risk on that is we're now seeing in our portfolio, and I see it anecdotally when I talk to people.
Yeah. No, I'm actually impressed that your performance is kind of keeping up with the index in a period where there's a lot of smaller markets are actually doing the heavy lifting for trend followers like us, and not the big one, and not the big markets, nor the big sectors. So so good on you.
maybe lucky. So we'll see.
Well, better to be lucky than smart, I guess. But there we are.
It's working for now.
Sure. And now, my own trend barometer finished the month, not the month, but to finish the week, or as of Thursday, at 43, which is still somewhat neutral to weak, which kind of ties in with what's going on for the SocGen Short-Term Traders Index, which is up 71 basis points for the month, but it's still down 22 basis points for the year. And for those who don't know, my own trend barometer is more short-term timeframes. That's in the algorithms. But as I mentioned earlier on, the index, or the CTAs and trend followers as a whole, actually doing okay so far this year. We have the Beta 50 up 2.25 for the month of February already, up 3.5 for the year. SocGen CTA index up 2.4, up 3.4 for the year, and the trend following index SG Trend up 3% and up 4.21% for the year. Comparing that to the traditional markets, MSCI World equities are up 2.37 and up 3.54 for the year. World government bonds down again in February, down 1% roughly. And the S&P 500 is up 3.77, obviously making new all-time highs this week, and up 5.52% so far this year. Now, I don't know if this is the right time to mention this, but maybe we'll talk about this. Are we going to talk about equities and stock picking and breadth and stuff like that later on today?
I'd be happy to talk about it.
Okay, all right. Okay, then I'll save my points for that. Okay, so you sent over a really good list of topics, Andrew. And although I think the first one we probably have touched on before, but you may have some other views thinking about it today, and then we'll go on to some topics we definitely haven't talked about before. But actually, I think the first one is very relevant. It's something that almost comes up one way or the other in the meetings that I'm having at the moment. And that's, should you replace bonds with managed futures, but also vice versa, because obviously bonds have suddenly become very interesting compared to a while ago, at least in terms of what they pay. So I'm very curious to hear where we're going to go with this from your perspective, Andrew.
Sure. So I say it almost as a thought experiment, right? Because people are not going to jettison bonds from their portfolios, but having done this for a long time and having spent a lot of time, probably would have been I was a history major, and I sort of like thinking about longer term things, but also sort of fascinating in terms of how people look at recent history and how they interpret it. I think what's happened in the 2020s as it relates to bonds is earth-shattering from an allocation perspective in a way that people haven't fully processed. Because in the same way that when interest rates started to come back up, most allocators going into 2021, 2022 had essentially low rates bets throughout their entire portfolio. If you like tech stocks and you like the S&P 500, which was largely tech stocks, being driven by tech stocks, it's hard to have that view unless you think interest rates are going to stay low. If you've been loading up on AA rated corporate bonds with the 1.5% yield and a 10-year maturity, if you think interest rates are going up, that's economic suicide, right? And so REITs, real estate, people are buying office buildings at low single-digit cap rates. So this was a trade that went through everything. And I think taking a bigger step back, the great trade of the 2000s and 2010s was owning bonds. And I think people don't appreciate how unusual that period is. So may I bore you with a few statistics to just kind of put it in context? Okay, so just running some numbers this morning. Since 1990, cash has earned you 3%. And it's rational to think about how much better am I going to do than cash over that period of time. So, by the way, my stocks, I'm going to use the S&P 500, home country bias, and I'll use the Bloomberg Ag for the measure of bonds. But basically, since 1990, stocks have done 700 basis points more than cash, which is what people call the equity risk premium, and bonds have done 200 basis points more than cash. But also the volatility of stocks has been around 15%, and the volatility of bonds has been around 4%. So when you look at it, they actually have identical risk-adjusted returns, a Sharpe ratio 0.5. Now, as Warren Buffett would say, when they say, if you didn't have Berkshire Hathaway, what would you do? And he said, I put 95% of my money into the S&P 500 and 5% in cash and not look at it. Stocks over that period of time since 1990 have gone up 28 times. Okay. And bonds with much less risk have compounded and gone up 4 times over that period of time. So, but in that, the 2000s and 2010s, the single best thing you could own was bonds. So here are those comparative statistics, right? Cash does 2% over that period of time, right? This was the great bond bull market. Cash does 2%. Stocks do cash plus 4, which we've forgotten about because we forgot that we had a lost decade for equities in the 2000s. And bonds do cash plus 3. And you think, well, okay, cash plus 3 is not that big of a deal, except for the fact that also the volatility came down to somewhere in the low 3s. And so the Sharpe ratio of bonds, with just that incremental increase in returns by 100 basis points and a drop in volatility, was 0.9 for 20 years. You had a max drawdown of 4%. So the incredible thing is when you look at the S&P 500 versus bonds over that period of time, for 16 of those 20 years, stocks have been outperforming bonds from the beginning. It's a straight line from the lower left to the upper right. So what's happened since, so what that did is there's a feedback loop, right? It means that this idea of 60, and by the way, stocks had bonds had a correlation of minus 0.1 to stocks over that period of time. So one of the big trends in the background has been, the whole wealth management world has gone toward model portfolios. And when you're building model portfolios, you're looking at the past and generally extrapolating it out to the future. So you've had basically building asset allocation models on the basis of an unsustainable bond market. And think about bonds, right? Think about how strange bonds are relative to equities. Let's say the company has bonds with a average maturity of 7 years. It means that they're essentially, the equivalent would be every year 15%, 14%, 15% of everything gets retired, and they have to keep reissuing it, right? How does the reissuing process work? When you read in the paper and they're like, bonds are rushing things into the market because of this, temporary drop in interest rates and credit spreads are really tight. You have investment bankers and smart corporations try to sell bonds when it's cheap for them to do so. And on the other side of the table, you've got guys who are in the business of buying bonds. They've got one hammer and they're going to buy bonds no matter where they're priced. That guy cannot sit there and say, oh, screw it, I'm not going to buy bonds for the next 5 years. He's not going to have a job. So the structure, the industry structure, is not designed to really give you the best risk-adjusted return on bonds. But it happened for 20 years because of this overriding drop in interest rates, because of the Fed's paranoia about deflation and constantly stepping in and quantitative easing over that period of time. So now look at the 2020s. Okay, in the 2020s, cash has been earning 2%. Stocks have been on a tear. They've done cash plus 1,000 over that period of time. And this has been a volatile period. So cash has done, so the volatility has gone from 15 to 20% in this decade. And so stocks, with that incremental increase in returns, but also a little bit higher volatility, the Sharpe ratio has gone from 0.5, which would be normal, to 0.6. Bonds, on the other hand, are down 1% this decade. And this is the part that people don't talk about enough. The standard deviation has doubled to 7. So you're doing 300 basis points worse than cash, but your standard deviation has gone up by 7, and your correlation and your max drawdown has gone from 4. I mean, it had a max drawdown of 4 over 20 years. Your max drawdown is 17%, and you have a positive correlation of 0.6 to equities. If this continues, there is no economic argument from an asset allocation perspective to have bonds in your portfolio. And it's not going to continue like this, obviously. But my point is that think about where we are in 5 or 10 years from now. And you're an asset allocator building a wealth management portfolio. You cannot pretend that bonds have no risk anymore. You cannot pretend that bonds are just this, so what it's going to, and you can't pretend that bonds are this perfect hedge anymore, because now you can point to a period where they clearly failed. Everybody who had a 40% allocation to bonds over the past 4 years has failed to diversify. It has cost them. And so that's where you get into. So when I talk about managed futures and why I think managed futures, and I could tell you the stats on managed futures, which you know as well. If you compare managed futures to bonds during the 2000s and 2010s, bonds were much better, right? You had identical, roughly zero correlation to stocks, but you had a third of the volatility. You had a much higher Sharpe ratio. You had, a third of the drawdown. I mean, you had it was simply a much better way to diversify your stock portfolio. So the headwind for managed futures was not just because ultimately all of these models are designed to protect you from equity volatility. Yes, you made 28 times your money over 34 years, but you go through brutal periods where everything looks like it's on fire. So you have to have, an iron spine to weather it. But this decade, your protection didn't work. And so I think when I think about managed futures, it's not just like I've seen a curious thing recently, which is we kind of see these surveys of investors, and a really, really surprisingly high number of people are saying, I want something that has very, very low correlation to stocks and bonds. And that's a reflection of the fact that bonds and everything that's linked to bonds, whether it's, REITs, whether it's property, et cetera, is just not working anymore as a hedge against the thing that would have made you 28 times your money, but was very volatile. So I think there's this, when I think 5 years out, and the guys that I know are building asset allocation models, there's going to be this existential reconsideration of whether 60-40 is the right starting point. And as they shake up that model, then the question is, what can we find out there? And usually they're constrained, right? If it's a sovereign wealth fund, they can do whatever they want. They can put all of Millennium and Citadel or whomever else. But what can we find that has low correlation that actually helps to diversify equity risk? And as I've said this a million times, the absolutely, utterly obvious answer, if you care about liquidity, if you need to invest in a UCITS fund or an ETF or some sort of a vehicle, is managed futures. And so there will be this natural buying tailwind associated with the strategy. And I think it's the opportunity for it to really go mainstream, but this is where I get into all of my pedantic messaging issues.
I like what you just mentioned. Obviously, the argument, the data argument as such, has been here for a number of decades. These, the data you run today is going to look very similar to the data you run, you ran 10 years ago or 20 years ago, meaning yes. And as John Lindner wrote about in 1983, adding managed futures to a stock and bond portfolio makes absolute sense, and which he later got a Nobel Prize for. But I guess what's happened now is what you point out to is that we now have a recent example where people really got into trouble. And of course, where we in a bigger picture would say, well, maybe the 40 years we had prior to 2020 was a unique period, and especially the last 20 years leading into 2020 was an extreme period. And now we're just going to go back to normal. And if you go back to normal, that means that most of the time stocks and bonds will be positively correlated. So you won't get the protection that you got in the first 20 years of this of this century. So that's the change that I see as well. But what it will take to change investors' minds, I'm still struggling with personally, I have to say. Because when I meet people nowadays, and even if we have a very good argument on our side, people will say, well, now that I can get 5.5% on fixed income, that's very tempting. So why should I even need a CTA product? Even if we can argue to them and say, well, you're not really giving up very little because we have so much cash in our products that you get that inside the ETF or the UCITS or whatever you buy, you get that as well. So you're really not giving up much, but you get this wonderful non-correlated return stream on top. I still find it to be a really hard sell, Andrew.
Sure. So, well, first of all, there are a million different kinds of investors. right? And we faced the same problem last year, right? We have everybody, cash was the obvious thing. And actually, I mean, in January, people were talking about it being the year of the bond, right? They were flat out wrong for 10 months. And then they got bailed out in the last 2 months of the year. But again, this sort of also goes back to the industry structure, right? The industry structure, you're an advisor and you're looking to your clients. And the psychology there is getting that quarterly coupon is deeply comforting and satisfying for most investors. The idea of capital protection and not losing money. I worked my whole life to make money. I don't want to lose it now. Like, I have an 89-year-old dad, right? He shouldn't be swinging for the fences on anything, right? It doesn't incrementally matter to him. What matters to him is, and the psychological value of seeing it, boom, it hits his account every quarter, matters a lot to him, right? So people will make decisions on the basis of their job profile. Bill Ackman has this great expression, basically, that incentives drive everything, right? And so what has happened is a whole industry has been built around this. Vanguard will go down with a sword in their hand about 60-40 portfolios because they've told everybody for 20 years, 25 years, that this was the simplest, most straightforward, easiest way to achieve your financial goals. And they were right for 20 of the 24 years. So it depends on the target audience. So my guess is the typical pension plan, which had largely gotten out of managed futures by 2020, will have an allocation in 3 or 5 years. These guys move really slowly, but they do like statistics. They do like looking at historical data. They spend a lot of time thinking about kind of things. So I would add one other thing. Not only has the 2020s been disastrous for bonds, and it's in one of my partners that I work with, you always used to say about it, one of the disadvantages of financial history is you only have one history. When he was doing his PhD in physics, you could run a million different scenarios, 10 million versions of what could have happened, and you can then kind of look at outcomes and things like that. We're stuck with one version of history, and so are they, right? They can never claim that bonds don't have a lot of drawdown risk. They will justify it because they were the ones who also told their clients, that they would never go down like they did. I'm sure there's not a single consultant out there that told their clients that bonds could go down 17% across their portfolio at the same time as stocks, or that the correlations would turn positive. So, but the other thing that happened, and I think this is where, just talk about the history, is 2022 is in the record books, right? 2022 was not supposed to happen from every allocator who had invested in the space, had a bad experience, and then told their clients the space was dead, right? But there will be new generations of guys who go back and look at it. I spoke to guys yesterday who don't have any exposure to managed futures, and they don't have the baggage, right? So the point is that it's not, I'm not suggesting that, you're going to find people with 60-40 managed futures portfolios, S&P managed futures portfolios. And I would argue every last breath not to do that if you're in the wealth management business. But I think the other thing is and we've talked about this a lot, is I think the marketing and messaging in the space is tough because bonds feel safe. Stocks don't feel safe, but we've had decades of people from stocks for the long run and people, Warren Buffett, everybody else saying, never give up on stocks. When it's down, if you're going to do anything, buy them, buy the dip, all this other stuff. There's a whole language around it. And, what I run into on the managed future side is it's a strategy that is complicated to explain. People like to get in and talk about the weeds very, very quickly. The guys who built and run these businesses like that level of detail. The pension plans, the family offices that others used to talk about like to hear it as well. It's interesting, it's fascinating. My God, cocoa. Let's talk about cocoa. But for the other 99% of people out there, it just scares them because they don't know what a futures contract is. Some of them don't know what shorting is. They know about these concepts in general, but they're just trying to help their clients to grow their money and have a smoother ride and to sleep at night. And so there's always a risk for them, whereas they want to help their clients do that. The more complicated, opaque, difficult to explain an investment strategy is, the harder it is for them to help their clients to achieve those financial goals without agitation. So I don't know how it's actually going to, how the whole thing is going to play out, but one of the disconnects that we've been trying to solve is that if you're an asset allocator, you're a guy building those model portfolios, you love things that are index-like. Because you're saying, because if you decide to fill an asset allocation bucket with a single fund, like this is in a sense what, as I said, AQR did an incredible service with the space when they launched AQMAX in 2010. Because they came out with an institutional quality managed futures product that they themselves were going to build and run, and it was priced at 121 basis points. Right. So for an institutional investor, or wealth management firm, that was a step function in quality and pricing relative to what things were. Not of their own fault, but rather allocators misinterpreted that. They thought, I love managed futures. AQR are the smartest guys in the room. I'm just going to fill my full asset allocation bucket with AQR. So that mutual fund went to $14.2 billion at the peak. It was, I think, 60% of the overall managed future space. Okay.
ETF
that
space.
Is a really, really, what's that?
Not how much of the managed future space, you said?
I think it was 60% of the
ETF space.
Managed futures mutual fund space.
Mutual fund space. Okay, yeah.
Mutual fund space,
good.
yeah. And because what people would say, because model allocators would say, they'd go through this analysis of the SocGen CTA index, and they'd say, hey, I want 5% in this, I'll put it all on AQR. Then over the next 5 years, because of however AQR configured their models, AQR underperforms everybody else by 20%. And the allocators of that, so imagine now you've made a 5% allocation to this space, and every time you sit down, you're like, the one guy we picked has done worse. So the feedback loop was not to say, next time I'm gonna pick 5 guys, right? Next time I'm gonna spread my bets. Because one of the constraints these guys have is that, when they invest in US large cap stocks, they pick an S&P 500 index fund or 1 or 2 funds. They don't, an institution will pick 5 guys. These guys have to pick 1. And so the opportunity that we saw was for that particular audience, this is and those guys care about fees, they care about the vehicle. We're going to try to give you a way of getting broad-based exposure to the space, something that looks sort of like an index, even though it's synthetic and simplified, because ultimately that's what they're looking for is in 5 years, if the SocGen CTA index does 5 a year, can this thing do 5 or 6 or something with a 90% correlation and not go through, long sustained periods of underperformance. And part of that though is, these guys are not familiar with the space. They're not the hedge fund analyst at a family office or an institutional investor. They spend rightfully 90% of the time thinking about stocks and bonds and whether they add a little bit of EM or they get out of EM and stuff like that. So this space has to be packaged in a way that they feel is understandable, logical, predictable in the sense of being index-like. And that's my theory. And in several years we'll know if it gets any traction or not.
Yeah, obviously you guys have had traction, and so has the industry as a whole. But of course, I'm still surprised by the underinvestment for sure in the space with those kind of that level of evidence on our side. But we will see, and we'll talk about it as it comes. I think we've covered a lot of the things that you put in your first point that we wanted to talk about. I just want to make sure, is there anything else that we left out? We've talked about the practical issues that they face. Do you want to move on to?
Sure. I guess the thing that I would just, my sort of concluding point is this point about is no one can erase 2022. And back to your point about why not just invest in cash as opposed to managed futures. Look, collectively, we blew it last year, right? We've been telling people that as soon as rates are higher, you're going to get cash plus, right? And let me let's dig into my, little napkin notes here. But from 2000 through 2020, the SocGen CTA index, net of all fees and expenses, did 200 basis points more than cash, right? So in a sense, it was like a watered down, risky, volatile, confusing version of protection that you would have gotten from bonds when bonds were, and the great thing. Now look at this decade. It's done cash plus 400. and Sharpe ratio 0.5, correlation to equities of minus 0.2, max drawdown of 10%. All those stats look great. But then everyone had said, when interest rates are higher, we're still going to give you cash plus. And the space gave you cash minus a lot last year, right? So the proving ground is going to be, this year, on the other hand, the opposite is true. So we get to the end of 2024. Let's say the overall space now had this incredible 2022, this comparatively lousy 2023, and then interest rates settle at 3% on the front end or something, and the space is up 6%. And that happens again in 2025, cash plus something, then the pieces fall in place for meaningful asset growth.
Yeah, I mean, I think that one danger is, of course, always to look at calendar years. Calendar years means nothing really in our industry because we know that that's just not how trends evolve, that they take any notice of what month we're in or anything like that. So I think it's very dangerous if you go out and you promise people just because rates are high over the next year or whatever period, we're going to give you X. This is a super long-term cycle. I mean, even an example from the firm that I work for, sometimes I come across investors. I mean, we're in our 50th year, right? 50-year track record in a few months. We're sitting at all-time highs as of yesterday. And people will still ask me from time to time if I think trend following still works as a strategy. And I'm thinking, well, there's 50 years of evidence of that. So I think it's an ongoing journey. And this is also why the narrative is important. Because even though we have all the evidence now for this decade, it's still going to take some time, as you rightly said, before it filters in. But the good news is that they can't just change the data. I think that's an important point.
See, that to me, it's such an interesting question when people say, do you think trend following still works? Right? Do you think value investing works? There's something about managed futures, right, where, and I have sort of theories on this. So there's something about managed futures where people love to kick it. Right. And part of it is that, like, if you didn't have managed futures in 2022 and 2023 rolls around, you are dancing. You are doing a victory dance. You've somehow been proven right. Right. And look, and 2023 wasn't terrible. I mean, we did worse than we underperformed by more than I would have expected. But then we'll probably bounce back this year. I mean, there's going to be noise in what we do. But overall, the space, coming off of 2022, but people were so focused on, you got caught on this whipsaw, or you got caught on that whipsaw. But I think that's what their job is, right? They're supposed to, they sit and they think about, what's the tough question that I can ask that's somehow going to shed light on it, and I'm going to get these guys in there, push them back on their heels, and they're going to figure it out. Have at it, guys. Like, I mean, I don't, to me, the whole point of trend following, and again, it goes back to who you're talking to, this question is, how tactical are you guys? You honestly think that you can tell me today not only what every asset class is going to do. I've talked to a consulting firm, they have 45 different asset classes that they model them out for the next 20 years. That you think that's going to be more accurate? I said, so to me, they said, why should we add a 46th thing for managed futures? I said, because it does something you don't do. You guys there's no way. I don't care if somebody told you World War III is starting in a month and with a 90% probability and all markets are going to crash. You're still not changing your portfolio. You're going to walk into that propeller blindly because it's your job. You're not supposed to move. On the other hand, here's a strategy, and I'm still wrestling with like a better way to describe it than managed futures, but here's a strategy that's nimble and can be contrarian and faster. And so if you're a long-term investor, you want a part of your portfolio to do that. But this whole idea of like, does it work? It's just, I find those questions irritating.
Well, let's move on. I think there's some of the things that we've already talked about, at least touched on. You wrote to me, let's discuss whether the hiking trade is over, what comes next. I think you touched on that a little bit already. And you mentioned that the whole space now is risk on. We talked a little bit about that. But then you raise another point, and that is who fared better, short-term or long-term guys. What are your thoughts around that? What was your thinking about it?
Well, I think there were two. Back to your point about calendar years, right? If the year ended on October 31, there would have been multiple years in a row where long-term trend following did better. And but November, December sucked if you were a long-term trend follower because, and I guess the way that I look at simplistically is, and by the way, I should say that our replication models are better at picking up longer-term trend than they are at picking up shorter-term trends. But in the U.S. markets in particular, we compete with guys who part of their claim to fame is that they introduce a lot more short-term models into what they do. So we spent a lot of time studying it. And, our general conclusion and look, these guys may have, magic modeling tricks that we don't have. But when we look at shorter-term trend versus longer-term trend, what people love about it is you are faster to get out at the inflection points. What people don't like to talk about it as much as you are subject to getting short-term whipsaws and head fakes. And so when we look at just the long-term expected returns and how, in 2022, when you get a decade of alpha from long-term trend following, you guys have multiple decades of alpha from trend following, longer-term trend following. That to me is the thing that's really valuable from a portfolio perspective. But we had two brutal inflection points last year. You hit March and things collapse. The rates go absolutely crazy in March. And if you've got all of these tripwires in your portfolios, you get out faster. Now, the irony of it was by the time things settled down and we weren't going into the recession by June and the banking world was saved and, and the carcass of Credit Suisse had been acquired by, consumed by the UBS whale, I guess. And then rates started going back up again. Those guys were wrong-footed, right? So when I was looking at us versus these guys, it's yes, they did much better than us for 3 weeks, and then much worse than us and you and other people and Alpha Simplex and other people over the next 6 months, and then they did much better in November, December, and then we're wrong-footed again in January, right? Because they had gone too risk on, too early, too long bonds, etc. So I think my view on it has, I would say, as an asset allocator, I think if you're thinking about investing in this space, your priority is to find long-term trend, however you get that. But the advantage of shorter-term trend is it's comforting. It may not increase your Sharpe ratio over a longer period of time, but if you want to feel like, look, when a long-term trend reverses sharply, it's horrible. You're like standing under the propeller. You're like, somebody pull me out of here, right? Like it changed. But having done this, you do get these head fakes in the market. So shorter term trend, has this sense of, it sounds great. Oh, we're going to get in earlier. We're going to get out sooner. And you just don't talk about the fact that, yes, but in the meantime, you'll be bloodied by, these week to week movements. So I think in the US, actually, what we've seen people doing, since that has value as an allocator, at least from a storytelling perspective, if not from an economic perspective, we see people actually pairing what we do with one of those strategies, and then basically being able to say we're somehow, getting somehow diversification, getting broad-based exposure, which is not. It's quite rational, and if we end up getting paired with these mutual fund behemoths as part of an allocation, I think that's great.
Yeah. No, it's obviously a discussion that comes up from time to time. There are periods clearly where you're right, where this narrative of short term is so powerful that a lot of the flows will go in that direction. But then people realize that actually in the long run, they're just better off taking the volatility that comes with the longer term timeframes. And at the moment, that's what you see with some of the short term guys where the flows are going out quite significantly. And in the last 5 years prior to 2024, the short-term traders index only beat the SocGen trend index 1 year. That was last year. It was down 1.77%. The trend index was down 4.17%. So not by a lot. And it lost out a lot over the prior 4 years in terms of performance. Then you mentioned something. You say that we could maybe get into a wonky discussion about stock selection not adding value today like it did in the 90s. That I'm going to leave to you to guide me into that one.
Oh, so one of the things. So this is. I hope you guys don't think this is sort of a pedantic history lesson. But I started in my first job was in 1990. I was an M&A investment banker working for this guy named Jim Wolfenson, who ended up running the World Bank. I was actually also in, and Paul Volcker was the chairman of the firm, which is where I got a little bit of taste of what Volcker went through in the 1970s and 80s. But the interesting thing about it, so one of the things you do when you're an M&A banker is you spend a lot of time, like we've got this client, and they want to buy something, and you do a lot of this analysis looking at what are called publicly traded comps for that industry. So, okay, they sell widgets. Let's look at all the widget manufacturers and do a financial analysis of, their profitability, et cetera, et cetera. And what you found back then was that if you looked at a given industry, there were companies that were obviously the A players, and there were a lot of companies that were the C players that were still around. Now, there were fewer of them that were around in the early 1990s than, say, the early 1980s or 1970s, because leveraged buyout firms were out there. The M&A world and takeovers had started to, to basically, if you're a really badly managed company, somebody, activists or somebody, would kind of shake it up. But the world back there in general was, and again, we're coming out of the 1980s, where the big horror of the 1980s was that when in the 1970s was when Japan is exporting cars to the U.S. It's not only that it's great for consumers, but it shines a light on the fact that a lot of American industry, was really had kind of sort of rotted over time. You had these corporate boards who weren't really paying attention. You had guys who, concepts that you think about today, like, should I repurchase stock? Should I have, what's the optimal level of leverage? How do I think about optimizing cash flow and return on capital? This was really, really rare stuff. And so the opportunity the LBO firms had was an ability to apply these more sophisticated ways of looking at companies and figure out, separate the wheat from the chaff. But broadly, by the early 1990s, if you're a stock picker, you could still look at an industry and say, okay, this company is a terrible company, but they're really cheap, but I'm guessing somebody's going to come along and shake it up. And lo and behold, so you could buy the bad companies, expect something to happen, or the pricing of these companies was not as great. And a lot of this was based on the idea that this growing belief that what companies should do is really focus on what they do well. In the 1970s and early 1980s, there was this idea of conglomerates. GE is going to have this kind of management playbook, and they can just buy companies in any industry and make them better and take advantage of it. That idea was essentially discredited by the early 1990s. And a lot of LBOs and people would buy these companies, they'd break them up, they sell off the pieces. They sort of realized that actually you could add a lot of value. And there was also a view that people in manufacturing and outside, like all the talent was going to finance and consulting and these things that people viewed as not, additive to the country's GDP over time. And so, so the dominant view about companies during the 1990s, 2000s, to 2010s was, focus on what you do well, focus on return on invested capital, return capital to shareholders to, drive up your stock prices. And that was driven by stock options, that was driven by independent corporate boards. If you didn't clean up your act, you were going to get acquired and thrown out. So it was a phenomenal period. Profit margins went up. And this is, again, going back to Warren Buffett, who I think in 100 years, people still think was, one of the smartest people ever in finance. Where he said, people said, why would you just buy the S&P 500? And he said, because you got 500 incredibly hungry, smart guys who run these companies, go to the office every day, try to figure out, how do I make money for our shareholders? How do I make money, and for myself, obviously. And you got corporate boards who wanted to do that. So American industry really turned around. And now look at the companies that are dominating it. So take a company like, a Microsoft or Alphabet. So these are, in a sense, the modern version of the old industrial companies, and they're conglomerates. Like, think about the fact that, Microsoft's in the cloud business. These businesses that didn't exist 10 years ago, but it wasn't discovered by some VC firm who invested in a company and then they become the industry disruptor. These guys are taking the cash flow of their businesses and they've become the capital allocators. They're the ones who are bringing AI to the world. They're buying up competitors when they think they're competitive because they know about threats from competition. So they're buying up companies. So you basically have these Frankenstein versions of the conglomerates of the 1970s, but are run by guys who are unbelievable. They're hardest working, smartest, full-throated, rapacious capitalists trying to figure out how to avoid having their companies become be disintermediated, etc. So the AI thing to me over the past year is a really, really challenging thing to alligators because it's not supposed to happen. You're not supposed to have these gargantuan industry players also be fastest and smartest about figuring out how to get in and dominate this new industry and deploy tens of billions of dollars overnight in yet another race to be first, to be fastest, to get a dominant industry share. So I think when people look at things like the Magnificent Seven versus other companies in the other 493, whereas yes, I'm sure you can have valuation disparities where you're overpaying. I think somebody just told me that you've looked at like a 50 PE on it. But on the other hand, they're also much, much, much better as businesses than anything that we've seen. And I think, so just part of what's fascinating is where we started, is when I see this view of, potential optimism also around, say, the U.S. economy and U.S. stocks and risk on, it seems integrated into this idea of, when you're betting on U.S. companies, if you had to bet on the Magnificent Seven, I mean, these are, again, it doesn't seem crazy to me to be betting on these companies. And I think that's what hedge funds started to realize about a decade ago was, yes, they might be expensive, but they don't obey the normal laws of competition where you're a dominant player and then these other disruptors come in and they start taking it away from you and you're kind of desperately clinging to this, melting ice cube and and 20 years later, somebody else is the dominant player. These guys know that history. They know what happened to Xerox and Kodak and Polaroid and all these companies that were this. So they are spending all their time trying to figure out how not to make that happen. And just sort of an interesting analogy, I think, for wonky hedge fund people is, last year was the 25th anniversary of long-term capital. And I was talking to journalists and others about it, and I was saying, the thing you have to realize is we look at that and we're like, this means one of the multi-strats is going to blow up. Those guys have been spending 25 years thinking about how not to be the next long-term capital. So I think it just shows a limitation of some of these historical analogies in that I think when you're thinking about these analogies, you have to think is, how's the world changed and why has it changed and what does that mean? And so if you're now a stock picker, where we started this, and you're giving money to, if you're giving money to a multi-strat hedge fund, you're relying on Ken Griffin and Izzy Englander and their teams of geniuses to figure out how much to put in this particular strategy, when to cut risk, et cetera. You've abdicated or you've outsourced the hedge fund picking process to these guys, and you'll pay them a lot of money for it. By analogy, when you give money, when you own Microsoft stock or Alphabet stock, you're also outsourcing part of the stock picking and capital allocation process that you would have done 30 years ago.
Yeah. And adding to all of that is the even crazier thing that the Magnificent Seven are now the Fabulous Four, because this year is very different. Almost 75% of the S&P 500's total return so far this year comes from Amazon, Meta, Microsoft, and NVIDIA. So it's even narrow. I mean, it is crazy. Not a lot of breadth in that market, unlike what we see in the managed future space at the moment, where there are lots of different trends. Is there one or two topics that you want to just touch on? You mentioned some hedge fund flows before we wrap up, or is there anything else you wanted to? You mentioned the dollar.
No, I think one thing. I just did pull up some data this morning, which I just thought was interesting. So one of the stats my partner sent me is that, as you know, in the U.S., the broader asset management space in the U.S., ETFs have been taking market share, for decades at this point. In the U.S., we were just looking at the managed futures ETF space versus the mutual fund space. And the mutual fund space, I didn't check these numbers closely, but I think it's basically, the mutual fund space peaked at about $28 billion in the third quarter of 2022. It's down to 17 billion now. So you've not only had that from giving up profits, but you've actually had meaningful outflows. The ETF space, which in 2022, I think there were 2 or 3 ETFs out there, maybe 4 ETFs. The number of ETFs has doubled, and ETFs are now about 10% of the overall space. So I think by analogy, I think people have fought doing these kinds of products in ETFs in the past because ETFs tend to be a more price competitive market. There are lots of reasons why it can be harder to sell an ETF in some of the major wealth management platforms. But I think what you'll likely, I think just by analogy, you'll see more people come into the ETF space. And, as we've talked about, one of your guests is supposedly on schedule to launch their ETF in the managed future space sometime in the first quarter. So going back to kind of the broader point of that adoption is there need to be more voices out there making the asset allocation arguments. And the ETF world is, if we're at 1.5 or 1.7 billion across all the funds in the space, you're still talking about 0.2% of the ETF world for a strategy that has more demonstrable diversification benefits than anything else that we found in the ETF world. So I think we are, at the very, 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 very beginning of what's going to be not even a decade-long process, but probably a multi-decade-long process. And it feels like it's building momentum and getting traction.
Yeah, I do worry that the final success for this industry, Andrew, will happen after my retirement at some point in the next 20, 30 years. But I will hope that you'll continue talking about it so I can just listen to people talking about the successes, the inroads that we finally made it to a 2% allocation of the overall equity or assets under management in equities, for example. Anyways, before
we'll be the old men quoted in some book.
It's like in the Muppet Show, these two old men sitting and bitching about these things like every week. Anyways, did you want to talk a little bit about, you talked about a flow, stock pickers losing money in the hedge fund space. You talked about the dollar before we wrap up, or how do you feel about it?
Oh, look, so one thing, a guy named Costas Morsalis from the Financial Times wrote, and with Lawrence Fletcher wrote a very good article the other day on this kind of existential crisis in equity long-short hedge funds, which have lost 150 billion in AUMs. And, when we talk about flows and what the future is going to look like in 5 or 10 years, I think we always underestimate how slowly people move. That what these investment ideas become canonical, and you get these industries that get built up around it that end up supporting it, whether it's everybody should have 40% of their portfolio in fixed income, whether it's hedge funds and the different categories of hedge funds. Equity long short really hasn't added value in a very, very long time. And I say this as a guy who runs an ETF that replicates equity long short. One of the great ironies of replication of things outside of managed futures is you basically can replicate, we've proven that the industry can be replicated through simple factor exposures, and also in some ways proven how uninteresting it can be as a diversifier, which is why managed futures has been so pivotal to our success, because you can say, A, in our opinion, we think you can replicate it, and B, it's amazing from a diversification perspective. But equity long short, this is, the stock picking thing is a real problem for them. Why are you paying somebody 1.5 and 20 to own the Magnificent Seven? Why are you, shorting hasn't worked in years and years and years. And so to me, an article like that, if those guys had called me and wanted some, pithy quote grenade, I would have said the question isn't why these guys have lost so much money. The question is why they still have so much today anyway. And I think that's where it takes a very, very long time for these ideas, which the economist Paul Krugman would call zombie ideas. Once they become canonical, it's very, very hard for people to give up on them. And so the change is coming, but it will come in a slow, halting, frustratingly slow manner. So hopefully you and I will not yet be retired when it really starts to kick into gear.
Finally, the Financial Times also had an article about the dollar. I think you picked up on that. hedge funds ditching the dollar bet?
We're sort of back to, at least in our portfolio, we're sort of back to this king dollar trade. And I think that's, where we started, where there's this very strange, like if you read, I don't know, I mean, you get drawn into CNN or Fox or something. I mean, it sounds like everything just sounds and feels horrible and depressing and angry and all these other things. But I think when you look at, when you look at AI, you look at AI, you look at technological developments, you look at, on the other hand, the resilience of the U.S. economy through these rate hikes. I mean, if you throw the other stuff aside, there is this optimism. And one of the things that I just find interesting, and of course with managed futures, it could obviously change relatively quickly, is just a sense that I think, the big theme a year ago was that we were in for a decade of resurgence of Europe. Emerging market was historically cheap. It couldn't get any cheaper. There was this kind of view that there would be this valuation normalization that would occur across different areas with sort of an anti-US bias, that it was, and at least right now, I see a lot more optimism ironically, because I don't think people think it's wonderful for democracy or a lot of other reasons, but I think there is this pushback on what people view as just an astonishingly unfriendly environment for businesses, and the prospect of some lifting of that and some return to appreciation that capitalism is the one thing that drives wealth. And I think if we start to see a pushback ahead of that direction, I think it's very positive, and the U.S. is well positioned for that.
Yeah. To draw on my Danish heritage, just to put a little sort of interesting observation, and that is, you're absolutely right. I think a lot of politics at the moment is focusing on the negatives, and there are a lot of negatives. I don't dispute that. But actually, the one party that is seeing the biggest surge in a positive way in Danish politics is actually a party where they really just talk about all the good things, and especially about the young people and the opportunities, instead of just talking about all the negatives about it. And I think if that's the kind of messaging that is starting to win support, that's a good thing, that we can start talking about all the positives, just like you and I talk about all the positives of trend following and managed futures. It's a bright world out there.
It's. I mean, the discourse here is not productive. So I'm glad to see that. I mean, I think there's there's a book called The Rational Optimist, which I recommend that everybody to read. And it basically talks about how easy it is to be consumed with pessimism, and how often that view is wrong, and why, somebody like a Warren Buffett would look through all of this and have confidence in these things over longer periods of time. And I think that's the side that we're missing, which is that when you look at something like climate change, but then you remember how many smart people are trying to figure out how to solve this, how many resources they're being given to try to figure this out. In the same way, almost the same way that whatever your view was on COVID, it was a really interesting period of time where it was almost like we had this alien invasion. Countries around the world, there was initially like fights, you can't fly here and we're not going to fly there, and, shutdowns and lockdowns and all sorts of crazy stuff. But there was a general collective sense that humanity was against some external opponent. And there's so it sort of brought together, in a sense, like all central banks were kind of working together. Everyone's working to make sure the financial markets kept functioning. Governments were, in theory, sort of sharing information and stuff. And that's just all fallen apart recently. But hopefully the pendulum will swing back, and we won't have this kind of further geopolitical descent.
Well, as one of our guests on the show end of last year, Neil Howe, the author of The Fourth Turning, said, things will get really, really bad, but they'll get so bad that the world actually will wake up and realize that is just not the way forward, and the next generation of leaders will take over, and actually community and support of and working together will be the way we eventually, and it's unfortunately not tomorrow, but eventually things will turn around again.
Well, I was talking to somebody who in the sort of 20s, like he was in his young 20s, and he was talking about the current political situation in the U.S. and and whether democracy was on its last legs. And God, I hope I'm wrong, but I just don't see it. Right? It's like, I mean, when we're talking about the fact that we have somebody who, whether he is actually an avowed authoritarian or truly anti-democratic, whatever you view, the guy's in court, right? And you can, whatever you think about the discussions are not, have his political opponents been thrown into the back of vans and, accidentally fallen off buildings? The conversations are, is it justified for politically motivated prosecutors to prioritize, going after this guy for things that I think most people would think in many circumstances or some of the circumstances are not remotely commensurate with the, prosecutorial action, but it's happening at that level, right? And the question is the Supreme Court going to allow, like, we have a functioning court system. So, I think this is where I just encourage younger people, like, God, read history. You want to see a democracy falling apart, read about Weimar Germany and what happened there. And it takes a lot more than this wonderfully prosperous economy that we have that goes through hiccups and to get people out into the streets and engaging in violence to overthrow systems. So there's just been, particularly since October, where it seems like people have just given up on actually reading books and history, and they're getting all their information from 30-second videos. It's just it's lunacy,
which is incredibly worrying, given the fact that probably most information today is curated for us as individuals. So what is the truth anymore? Well, the truth people can get on this little channel, because we talk about the truth when it comes to trend following, systematic trading.
We're truth tellers. This is where everybody should go.
Exactly.
For all of their information.
Don't
I sound old?
We deliver the good and the bad here. But yes, no, it's super interesting. And of course, with so many countries going to the elections or having elections this year, it will be a very different year when we talk a year from now, for sure. Anyways, let's leave the politics aside because I normally tend to avoid too much of that. But what I will say is that if people like these positive conversations about the bright future that trend following and managed futures have, and all the other stuff that we talk about, of course, head over to your preferred podcast player, Amazon, Spotify, Apple, whatever it is, and leave a rating and review. It certainly helps. And of course, even better, if you would also share the podcast with your friends and family, we would be ever so grateful. Next week, we'll probably leave the politics aside because we're going to be joined by Rich, and I'm sure he has something up his sleeve that will be another masterclass more into the weeds. Was the word I was looking for. The weeds of some of these benefits that we see, at least in this little space. And of course, if you have any questions, you can email them to info@toptradersunplugged.com, and I'll do my best to bring them up. From Andrew and me, thanks ever so much for listening. We look forward to being back with you next week. And in the meantime, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.